So good afternoon, everyone. Warm welcome to this latest investment update. I hope everyone is in the building. We have a lot to talk about today. Markets have snapped back, lots of things going on, lots of turmoil left and right. So with lots of things to discuss today. But first things first, we of course need to have a look at the disclaimer, guys. That basically means please don't do anything silly with the information that we will provide you today. Got to do it, unfortunately, but yes, there we go. So here's an agenda. We've prepared 3 sections for you guys today, as usual, as we've done the last few times. And the first thing I'll do, we'll pass in review the markets in March. We'll have a look at exactly what's been going on over in US equity markets, over in Europe, what's been driving this upturn again in the markets. And then second of all, we'll have a look at our own portfolio positioning. So what kind of things are we doing to our own investment strategy? What kind of performance have we been generating over the last month as well, both in forward Lucy and forward quant. Then in part 3, it will delve into some of the really key, the pertinent questions that investors are asking themselves now for the coming weeks. But let's get stuck in then with a bit of a market review as promised. So here, if you look at the United States, you can see that the rebound has been pretty strong, right? Since the lows there in March. You can see that there on the left-hand side, the S&P 500 bounced from the lows around mid-March onwards. If you look at the tech-heavy NASDAQ, very similar story there. And now it seems in the US that all the losses related to the war between Russia and Ukraine, they have been recouped. If you look at these 2 major indices, it's a similar story over in Europe. There we can see is that it was really stark downturn, right? In late February, early March. The DAX fell a lot. Germany was really ravaged by this outbreak of war. But we've seen a strong rebound as well, but the rebound hasn't been as strong as over in the United States. So you can see that in Europe, there's still some risk in there related to the Russia-Ukraine war, right? So not just in Germany here, but you see that in Italy, but also in Spain and French markets, which we'll talk about a bit later on, right? We have some more political risk coming up in France there as well. Now, I just want to spend a couple of minutes highlighting why we've seen this rebound, right? It's quite strange. We have a war going on. We have acute inflation. So what's happening here? Why are the markets able to recover here from those war-induced lows? Well, one of the first things that we should know is that this is a good old-fashioned sentiment reversal. Let me explain a little bit what that is. So markets are these massive, huge, impressive calculating machines bringing millions of minds together. But we should note that they are not perfect, right? They have a tendency to overshoot on the extreme. So they move up too much on good news, for example, and they fall too much on very bad news. And obviously, the war in Europe is the ultimate example of shocking bad news. And as we can see on the right-hand side, sentiment absolutely collapsed. That little circle there on the bottom right. So the last time sentiment was that bad was back in March 2020 with COVID, and then back in 2008 as well. So really a stark collapse in sentiment. And when we see this type of intense collapse in sentiment, what it tends to mean is that markets become ripe for reversal. They become set up for reversal to kind of correct that overshoot. And you can see then a big bounce off from the lows. And that, it seems like, is exactly what happened in mid-March, and especially in those markets where sentiment had collapsed the most. Now, it also helps if there are fundamental reasons behind this drive up in the markets. And we've had these fundamental reasons, and they've been related to developments to the war. As we noted last time around, markets have been looking at 2 main risks coming from this war. What are those 2 main risks? Well, we note there that the principal risk is a direct confrontation between NATO and Russia, right? This could lead to World War III, a broader war in Europe. It would be an absolute disaster. Economic growth would go down the toilet. Equities would be destroyed, no doubt about it. The second risk is a massive energy crisis in Europe, right? Which is brought about by a cutting off of Russian gas supplies, energy supplies, and that will then drag down the global economy into a recession. Of course, not good for equities either. But as the month has progressed, markets have assigned increasingly lower probabilities to these 2 risks, which has been helping, right? Why? Well, we've seen these diplomatic overtures between Russia and Ukraine. They've started, right? Talks have started. And Russia has indicated that it wants to focus on the east of the country. So it shows to investors that this is a more and more contained conflict within the Ukraine. Now, in terms of the rhetoric against Russia, that has really tuned up a lot over the last number of weeks, no doubt about it, especially in Europe. But policymakers in Europe have also made clear that they want to keep the gas flowing. It's not in their interest to cut it off because it would mean a deep recession for Europe, and that is not good for politicians currently. Now, also helping things is the economy. The economy continues to hold up reasonably well in March. So particularly in the US, but around the world as well. So the manufacturing sector has been resilient. It's been strong. You can see that there on the pane on the top right-hand side. If it's above 50, it means it's expanding. Why is this occurring? Well, we still have strong goods demand in the economy. There's lots of pent-up savings from COVID that people are drawing down and spending. And we have robust labor markets, especially over in the US. Lots of jobs still being created. Wage growth remains good as well. So goods demand is there and it's helping activity. In Europe, as you can see, that little line there has started to just hook down somewhat, but thankfully it also remains in expansionary territory as well. Last but not least, the services sector as well is coming back into form because COVID restrictions are being lifted. So we are seeing most countries now leaving the pandemic behind them. So they're opening up, people can consume services again. You can see that there on the bottom right-hand side, there the data has now also started to hook up, and it is the same for March. So the economy has remained resilient, and this has helped bolster risk appetite in the markets throughout March. Now, so much for a review of the markets. I hope that's understandable, that we can explain this bounce that we've seen, which is really somewhat unusual. Now let's go into what we've been doing ourselves at FWU Invest with our funds, with our positioning, with our strategies. Now, I just want to highlight initially, like I did last time around, a bit of a philosophical point. What do we do here? Well, our investment strategy is it's fundamentally driven by a quantitative approach. Now, what does that mean? It means that we make decisions based on algorithms and models. So we don't make subjective judgments ourselves. It's not like what my boss says is a good idea, what I say is a good idea, or my colleagues say is a good idea. We let the models and the algorithms guide us. They help us navigate the investment world. And for us, it leads to a less emotional approach, a more disciplined approach, and a more consistent approach as well, which I think is good for us, but it's also good for you guys. Now, one of the models that we use for asset allocation looks at two principal components that are central to asset allocation. It looks at the monetary environment and it looks at the economy. So what is that model now telling us? Well, if you look at the monetary side, I mean, the news is not really good. Let's be honest, and the model is really flashing red on this one. I think you guys know the story. We spoke about it last month. The monetary environment is not great for risk assets such as equities right now, right? We have interest rates going up in the US. They've also been trending up somewhat in Europe as well. The Federal Reserve, the main central bank in the world, is now very much in tightening mode, right? They've upped rates by 0.25% this month, and we could probably see a 50 basis point move in May as well. And all the while, inflation remains elevated, right? Pushing the central banks in this direction. Now, on the other side for the economy, the global economy is holding up, right? Remains resilient as we've seen. But what we need to note this month is that some of the risks, some of the concerns are beginning to pile up. So we have uncertainty related to the war that continues to linger, especially in Europe. We have continually elevated inflation that can pose problems after a while. And we have the Chinese economy, which also is showing lackluster growth right now. Let me just unpack this a little bit more for you guys, this more fragile economic environment. Now, the concerns that we've had around inflation here, for example, they've been around for the last number of months. But what's happened now with the war is that they have been heightened. They have been amplified, as we note there. And there is a risk that if we see prolonged inflation, that this really begins to damage consumer confidence. And as it damages consumer confidence, it can weigh on demand throughout the entire economy. As you can see on the right-hand side, electricity prices, for example, in Europe, they have exploded. And as a larger share of consumer income must be spent on the likes of energy there, like electricity, also on food, it means that it could displace spending elsewhere, such as on discretionary items, right? Are you going to buy that new washing machine? Are you going to buy that robot mower or car that you had your eye on? Well, the question here is that maybe you would not be inclined to do so. And the real danger here is what economists are really focused on, is that if demand begins to sap, this threatens the labor market and you see unemployment starting to rise. And when unemployment starts to rise, it tends to spiral upwards. It can be quite difficult to stop. And then, of course, we are in a bit of a real situation. Now, for businesses, the supply chain pressure has also re-intensified, which is also not particularly good news. Again, the story a couple of months ago, and we noted it too, is that once we see a loosening of these pandemic restrictions, this was supposed to lead to a loosening of the supply chain problems, right? And that goods would arrive on time, etc., etc. The problem is, though, that the war and developments in China have changed that picture. So we have issues, for example, related to the airspace over Ukraine and Russia, making air freight more expensive, more difficult. The sanctions means that large parts of the global supply chain are now been excluded by excluding Russian companies. They're big producers of metals, important metals, so precious metals, but also industrial metals. Ukraine is a big producer of neon gas that goes into microchip production, right? Microchips are the lifeblood of the global economy, the modern economy, right? So this is posing issues for supply chains. And then if you look at China, what is going on in China? Well, they're dealing with an Omicron outbreak, and they're dealing with it in a very draconian, hard way by imposing lockdowns in major cities such as Shanghai and Shenzhen. You've seen factories close, you've seen the ports operating at less capacity, exports have started to stutter. So again, further hitting global supply chains and potentially then damaging business confidence if this continues to drag on. So it's not surprising here as well that we've seen market volatility really starting to rise during this period. Higher volatility for us also means higher risk in the funds. And you guys know, one of the central components in the forward quant concept is the idea of risk control, which we determine using rolling volatility. So that basically means looking back at the last month, last 3 months, last 6 months, last 12 months. And as you can see there on the right-hand side, volatility has really started to shoot up. Like on a 1 month basis, bam, shot up like crazy. 3 months, it's really trending up as well. 12 months, it's been trending up too. Now we need to bring that down. It necessitates caution from our side. And by keeping volatility relatively low across the funds, remember what we're trying to do there is control risk and increase the downside protection during this period. Because during periods of higher volatility, the probability of an accident becomes higher than as well. An accident meaning a drawdown in the markets. So coming to the allocations then, this means that we are lowering the equity allocation. Remember, it's not a disaster what's occurring here. Growth does remain resilient, but we want to control risks better. Risks are rising, so we need to lower the equity allocation somewhat. What do we do with bonds? Don't like bonds. It's not a good time to be investing in bonds, especially in government bonds. Higher inflation, higher rate environment, not ideal for bonds, not at all. What we have done, though, is up the allocation to cash. And you guys will say, well, you can't make any return in cash. That's absolutely right. But we want to control market risk. And we don't take market risk if we are in cash. Now, the 3 pillars of risk mitigation that we mentioned last month, they remain in place. So in terms of derivative strategies, our hedging model has been flashing red again throughout March. So this means we've been protecting the portfolio by putting put options on. And this provides even further protection during these high phases of volatility. So very important. What we've also been doing is moving more and more towards the United States. As we saw, the United States markets remain more resilient. The dollar as well also tends to do better when the global economy is starting to wobble somewhat. Then we also up the allocation towards energy once more, right? During geopolitical crises, especially involving large oil-producing countries, energy tends to do well. And of course, during high inflationary regimes in which we find ourselves, energy also tends to perform. Now, what about performance? Now, you can see here the DRC, we're still up nicely over the last year or so, around 10%, but we should note that we have lagged during this rebound phase, as you can see on this chart there. The market has gone up faster than we have during the last month. So let me briefly explain here. So why is this the case? Well, it comes back to the principle of protection, right? One of the main ideas behind forward quant is risk control. And we should not be running too much risk during these volatile phases in which we find ourselves. This means we've been using put options. Put options are expensive. So when markets then shoot up, we have higher costs. So we don't really follow markets completely on the upside. But we should bear in mind that a large part of the downside was protected during this period. But we've had to pay for this downside protection. Then if we look at Forward Lucy, there the performance is significantly better during this period. So nice outperformance over the last year or so, also during this rebound phase. This is because Lucy is a more aggressive fund, right? We don't have the risk control stuff within Lucy. So it can really rebound fully with the markets then as well. All right, guys, we're almost there. Let me just throw some key questions out there. Something that we have been looking at. So what does the market focus in April? Unfortunately, it's probably going to be on more political risk. So markets have their eye on the election in France in the coming weeks. We've seen volatility in French equity markets moving up. We've seen sentiment towards French stocks starting to decline over the last number of days. So what's going on with this election? Well, what we're looking for, what investors, what markets are looking for, the best scenario for us is business as usual, right? And that means that we want to see another Macron win, ideally, from a market perspective, right? He's been making the right noises over the last 5 years. He's fairly business friendly, he's market friendly, he's about innovation, cutting down the states, more flexibilizing the labor market, all that kind of stuff, which is nice, right? Which investors like to hear. The problem would be if Le Pen wins. And the probability of her winning has been rising over the last week. So it would mean that the far right would hold power in France. And this, of course, has implications for a whole bunch of stuff. Like it has implications for the European Union, the future of Europe, the future of the euro. It also means that France might turn much more protectionist, which means lower growth also going forward. So really some key questions that come out of this election and some reason for worry again for investors. Now, let's do some quick fire questions before we leave. So what will we do if Le Pen wins in France? Well, again, just to point out, we are systematic investors, we're quantitative investors, so we would look towards our models, our algorithms to guide us. Now, we've built these models and algorithms, so we have a decent idea of where they would be turning us towards, but we would be moving away from the euro, most likely. Momentum in the euro would collapse. It would go towards the dollar. The euro would be hurt quite a lot if Le Pen wins. And we've been moving away from European equities again. So this move towards the United States, higher US allocations, that would continue. Now, another question that we've got recently is, what are you doing with emerging markets, EM? So interesting question. We haven't spoken about EM in a while, but we'd have to say is that based on our models here, the prospects for EM, they're not especially appealing right now, right? When US rates are rising, when interest rates over in the US are going up, it tends to suck money, suck capital out of emerging markets and return it to the US. And at the same time, as we saw, the Chinese economy is pretty sluggish as well, and EM is highly correlated to China, so not good news on that front either. And a final thing related to the war, we've seen significant food inflation there as well. And a lot of emerging markets, they have large stratas of the population that are quite poor, right? And for these people would pose a severe issue if food inflation continues, and that could pose then social stability, political stability issues, which in turn are not good for economic growth and corporate profits either. So what kind of investment opportunities do you currently see then? Well, yeah, it's not all doom and gloom, right? And no matter what kind of market environment you're in, there are always opportunities to be had. As we noted last time around, the defense industry is in a structural upturn as well in Europe and the US, but also globally. it's really primed for structural outperformance, is because of big power rivalry, right? We've seen big powers now increasingly come at loggerheads with one another. Big power rivalry is on the up, and hence military spending, defense spending is structurally on the rise. This is not an ESG theme, but unfortunately it is the new reality. And of course, during geopolitical stress, gold always remains a decent place to have some value. All right, guys, we've almost made it. Let me just try and wrap it all up for you guys in some key messages. So we saw a reversal in March. Markets had overshot to the downside. This has been reversed, right? Sentiment had collapsed and we saw a bounce up. It became clear that the war would be contained to the Ukraine and that we wouldn't see an escalation in the energy crisis. And at the same time, the economic data has also remained pretty good in March as well. Now, a recession does look unlikely, but the risks to economic stress, they are moving up, right? As we saw, consumer and business confidence are being damaged, supply chains, inflation. At the same time, the Federal Reserve is hiking rates into this environment. We have volatility that is going up as well. We would note it's not a disaster right now. There are still opportunities in the markets, as we said, but there is now a need to scale back somewhat on risk. And that's exactly what we've been doing throughout our funds. And with those words, I wish you a fantastic end to the day and a fantastic end to the week as well. Thank you very much.